We continue to see signs that the U.S. consumer is reaching their breaking point, which starts tomorrow, could push them right over the edge. Let's turn to Bloomberg, where we picked today's story up with the headline, "Hell no," as a shock $934 bill shows tariff pain is about to hit U.S. shoppers. And starting tomorrow, what we're facing is that exemption on small packages is going away. But the problem is, for a lot of consumers, they could face getting a bill months later to pay the tariffs. And again, this is going to be completely unexpected. And as we already look at American households that are struggling financially due to inflation and a weakening job market, this is one thing that could push them right over the edge. And consumers are all but assured to encounter similar shocks of their own starting on Friday, when the U.S. ends a long-time exemption allows parcels worth less than $800 to avoid tariffs. The so-called de minimis exemption for years allowed parcels carrying low-value goods to enter the U.S. duty-free, allowing U.S. consumers to take advantage of buying direct and saving a ton of money. But now those days are over. But the problem isn't just the fact that they're going to pay tariffs on it, it's how this is going to show up. And again, this is going to be a largely unexpected and come to a shock to many Americans. And starting on Friday, parcels entering the country will be assessed duties based on the country of origin tariff rate that Trump imposed using his emergency powers. Alternatively, package shipped via international post could be assessed with a temporary flat fee of $80 to $200 per item, but that's only going to be here for the next 6 months. But still, can you imagine getting something and then a month or two later getting a tariff bill for $80 to $200 or maybe even more depending on what you bought? This is going to, again, come to a massive shock for a lot of households and could cause people to cut back their spending. And if you think about the impact that's going to have on the global economy right now, as we look around the world, what do we see? Rising inventory levels. And a lot of manufacturers and wholesalers and retailers need to see these goods moved. And right now, this is going to cause a lot of consumers to rethink their spending out of fear they could get a massive tariff shock. It would be a disaster if you're trying to get a consumer to deal with it, and that's absolutely right. Take a look at this example of a college senior in Alabama who ordered a $1,000 pair of Italian-made boots from Canada. Now, that's a lot of money for boots to begin with, but look at this. He received a $190 bill from FedEx about a month after, and again, he thought it was a scam at first, and you can better believe that a lot of other Americans are going to feel that way, because as we look at the global economy, we can see for a lot of households, it's not working. We can see their hours worked are dropping. We can see rising inflation. We're seeing a lot of stress show up in the summer over electric bills. And this, again, could push things right over the edge. And we see further evidence of stress on households as we turn to Dollar General as they lift their sales outlook as shoppers seek bargains. Now, I want you to understand, when companies like Dollar General or Dollar Tree or Walmart come out and say, look, our sales are rising, this is fantastic, it's not a good sign for the U.S. economy, because what it means is more Americans are seeking bargains, they're trading down, and this, again, is a red flag. It's telling us that everything we know about the economy is now headed the wrong direction. But something that shouldn't be going the wrong direction, that's your trading account, because we make it so easy for you to make money. Let's take a look at this trade on GDX. This came from our new Metre strategy. We put it out to our subscribers on the 21st, and 6 days later, they were stopped out for a 4.11% gain. And my friends, we make it so easy for you to make money trading. The night before we give you the signals and the risk control levels, you just have to pick and make the trades the following day, and then we update you on those risk control levels all along the way. All you had to do is grab those links in the description below, use the coupon codes for your free 30-day trial. Stay tuned to the end of the show to see how we're changing the game when it comes to trading. Now, let's turn back to Dollar General, because as an increase in higher income shoppers are looking for deals, it's helped them lure more traffic into its stores as even its core customer base feels more squeezed. So you think about this de minimis exemption is going away, and consumers are going to get squeezed. They're going to get hit directly with those tariffs. And so all of a sudden, what we're seeing is further financial stress that's driving more higher income people to trade down. They're going to Walmart, they're going to Dollar General, they're going to a lot of these discount stores because they need to save money. And remember, yesterday we talked about how people can't even afford a pizza. We're seeing people cut back on their spending on clothes. It's a continued sign that the U.S. economy is going the wrong direction. It's not having to do with prices. It has everything to do with incomes. Let's take a look at this chart here, the Consumer Price Index in blue, and we can see that inflation has been running right around 2.5%. The problem is, if you go back to 2024, you can see average weekly hours of production of non-supervisory employees have remained largely flat. Yes, they've got some pay gains along the way, but their hours are flat. So for more than a year and a half, people have really seen their pay be static. Meanwhile, inflation continues to rise. Now they're going to get hit with this de minimis exemption on those small price goods. And again, you start to understand why people are turning down, why they're going to Dollar General. And again, it's not a good sign for the economy. The company appears to be benefiting from a better mix of discretionary merchandise, lower theft, and price increases. And this is interesting because we heard from companies like Walmart and Home Depot said, look, we want to raise prices, but we can't, but we're trying to raise them where we can, where we think customers won't mind. And here Dollar General is saying, look, because our prices are so much lower, we can actually raise prices and benefit from this, and customers are happy to shop here no matter how much money they make. And again, you think about the dangerous sign this is pointing to the economy. As consumers continue to trade down, it means they're finding pressure on other parts of their finances. One of those is coming from rising energy prices. And soaring power bills in the largest U.S. grid pose a massive risk for consumers, as we see electricity prices nationally now rose at twice the rate of overall inflation in the past year and are holding near a record high. So households aren't getting a break here. But if you think about the problem this is causing, we know that paychecks have largely been unchanged for the past year and a half as hours worked have remained static. Meanwhile, energy prices are rising much faster than inflation. So you can think about the impact this has on household budgets. It means their discretionary spending drops, and it's likely going to drop even more due to this de minimis tax on these small price goods, because when people find out just how much they're paying in tariffs, they're going to cut back their spending anymore. And what this is going to lead to is even more people facing the unemployment line. And again, this is not a situation that's going to get better. In the coming years, America's reindustrialization and the AI race will require a significantly larger supply of around-the-clock, reliable, and uninterrupted power. So what we can expect is this situation isn't likely to improve in the years to come. In fact, the pain could even be more. Imagine being in the midst of a recession and facing even higher energy costs. What we could see is a prolonged recession here as all this inventory buildup gets stuck and consumers can't afford it as their incomes continue to get squeezed. But one thing consumers have benefited from is that food prices haven't been rising nearly as much, but that could change, and soon. As tariff squeeze is now hitting farmers as fertilizer prices soar. The squeeze highlights the financial strain on farmers as they contend with depressed crop prices and ongoing trade disruptions. But from a consumer standpoint, they've actually benefited a bit here, because what we've seen is crop prices have dropped. But this could change in a big way, because as fertilizer prices go up, they're going to have to pass on to consumers. And then if you start to see a big increase in crop prices, watch out. You're going to see the cost of food surge. And again, you talk about the impact this has on household budgets. You know, we know rents have been going up, but the problem is we now see energy prices rising. We could see food prices rising at the same time. If all that were to happen, you can see why we're on the cusp of hitting the breaking point, one that would lead to a complete collapse in spending, and this would lead then to a massive amount of unemployment. And the evidence of this drop in discretionary spending, well, that's showing up at Best Buy, as our outlook is now clouded by tariffs despite sales rebound, but they didn't rebound nearly that much. Comparable sales rose 1.6% last quarter, boosted by strong demand for gaming and computer equipment. But the problem is inflation is running at 2.5%. This is an issue here because we continue to say that what's happening in the retail space is that retail sales are falling. They're contracting. And as this happens, what we're going to see is more retailers are going to be forced to lay off. The evidence is clear as we take a look at this chart of real retail sales in blue against corporate profits after tax. And what we're facing right now is that retail sales are going to roll over and go negative. The problem is, as that happens, you can look back to the financial crisis, to the dot-com bubble, and you can see as retail sales drop, corporate profits shown in red goes right alongside with it. Of course, we know when corporate profits start to dip, there is a point where businesses go into survival mode, and that means, of course, laying people off. But we're not seeing that just yet. But again, we're on the cusp of what we could see as a massive unwind in the labor market. as initial jobless claims refuse to show any signs of cracking, but I think it's coming in the second half of this year. Let's take a look because initial claims hovered still at historical low levels, 229,000. Continued claims staying relatively unchanged at 1.954 million. So what this is showing us is that while we have an issue of structural long-term unemployment problems, there are still jobs being created, at least at the same rate that people are losing their jobs. So that's a good sign. But the problem is, this could change and in a major way, because I believe if we see continued claims break over 2 million, it's game over for the U.S. economy. But right now they're hovering near their highest level since 2021. They kind of plateau and then they go up, they plateau and then they go up. And the risk is, based on what we're hearing from CEOs right now, that we could be, again, on the cusp of consumers hitting that breaking point as they find themselves on the unemployment line. Let's take a look at CEO confidence in red overlaid against U.S. initial jobless claims. This is a 4-week moving average in green, and you can see the relationship of where confidence goes, the job market follows. But the question is, if the confidence is plunging here, why aren't jobless claims following suit? And the issue is, if we continue to see margins get squeezed, if we see profits contract, you better believe the CEOs are going to be forced to lay people off and in a major way. Let's take a look at this chart of corporate profits after tax in red against continued claims in blue, and you can see again very clear evidence that a contraction in profits means that companies are going to cut expenses. This is what Domino's said they're going to do, but once they've cut everything they can, they're going to start cutting employees, and that's a risk we're facing right now because we already know that corporate profits are likely to head right back into contraction because demand is dropping. And again, the evidence is clear. As we now turn to Tesla's factory in Germany, you can see a perfect example of demand dropping that's likely to lead to a large number of employees losing their job. As Tesla's German car factory looks vulnerable as sales keep sliding, posting a now more than 40% decline in new vehicle registrations across Europe. And it's difficult to read Tesla's numbers and not worry about job security for the roughly 11,000 permanent workers in the company that employed at its lone European car factory. Because again, we talked about this the other day, that even as demand goes down, the problem is you have too much capacity. And what happens is businesses start competing for customers, prices start coming down, and this means there's going to be winners and there are going to be losers. And for Tesla in Europe right now, well, it doesn't appear they're going to be a winner. Because Musk can't blame a weak market as total car sales jumped the most in 15 months when industry-wide battery electric vehicle registration surging 34%. Again, as I said, there's going to be winners and losers, and based on this de minimis tax, you can see American consumers completely going to be losers here as they now cannot afford to buy direct because they're going to get a surprise tax bill. You can see that on the discretionary side, based on what Best Buy is telling us, that again, there's financial stress building in American households. We can see based on the continued claims data, if that were to break out, well, we already know it's going to be a major pain point for a lot of households. But the problem is, as demand continues to slide, there's going to be businesses that fail, and along the way with it, a lot of people out at work. But just because we're likely to see the economy turn lower doesn't mean you can't make money in the markets. Let's talk about our new Metre strategy. And this is an advanced trading system that combines 9 professional trading strategies into a single intelligent signal generator. It provides 31 more frequent buy signals and individual strategies while maintaining a high quality through multi-strategy consensus. It pulls in the Bravo 9, Turtle Trading, 200-day moving average cross, golden cross, trend pullback, RSI divergence, 520 EMA cross, channel trading, and Fibonacci retracements. It's fully optimized for swing trading with a target hold period of 2 to 15 days, generates over 155 signals per year, and has a success rate of 55% with fast profit taking, which far exceeds any of the data on those other strategies. Almost all of them have a success rate of well under 50%. And again, we're changing the way people trade. Now, right now, you can get these Metre strategy trades at no additional charge. Now, we have 2 reports. Our flagship report, this is our CTA Timer Pro. We look at machine positioning each and every day. We try to position our subscribers ahead of a major surge in machine buying. Now, how do we do this? Well, we look at how they're positioned, but we run a historical overlay because machines only trade with a look back of somewhere around 3 to 6, some sometimes even 12 months. So when we see they're offsides and they need to buy, well, that shows right up on our hot list. But maybe you like to trade momentum signals. Well, that's our Momentum Timer Pro. But one of the problems with trading these technical indicators is people get in late, they get out early, they're all over the place, and we simplify it. We aggregate these signals together and we run a trend overlay. And again, when we see all the indicators moving up, that shows right up on our hot list. So you get the daily report, you get the tradable signals, including my new meta strategy trades. You get my opinion on the best trades to take. We give you risk control levels, a full tracking of all our open trades and returns, a weekly update. And here's the best part. You don't even have to put a dime out to try a report. That's right. You get a 30-day free trial. All you have to do is grab those links in the description below. Use a coupon code for your free 30-day trial. For that, I'm Steve Van Beater. Thanks for watching. Thanks for being fans. Bye now.